Hello, welcome to the video. My name is Millionaire and today we are going to be talking about stocks. If today is your first time of joining the class, I would like to specially welcome you. And if you're a returnee, welcome back. It's good to see you again. In today's class, we're going to be addressing one of the greatest wealth generating platforms of all times, the stock market. If the thought of investing in the stock market scares you, you're not alone. Individuals with limited experience in stock investing are either terrified about the horror stories of the average investors that lost 70-80% of their portfolio value, or probably a hot stock that came into the market and people thought it was going to make them thousands and thousands and thousands of dollars, only to see that it was all lies. It was just empty promises. The reality of investing in the stock market is that it carries risk. But when approached in a disciplined manner, this is one of the most efficient ways of building long-term wealth and prosperity. The stock market is a platform that brings together investors and traders so that they can buy and sell stocks. It is a vehicle. Let me give you an analogy. Your 7-year-old daughter walks up to you and say, "Hey mom, I'm going on a road trip with my friends. We're going to New York City. May I borrow your car for the weekend? We're going to be back in a couple of days." What are you going to say to her? Are you going to say, "Yeah, this is okay, you can have it. Yeah, you finished your homework, you've done your chores, you've been a good girl, you can go with your friends. Make sure you call me when you get there, don't text and drive"? Is that what you're going to tell her? Or you're going to say, "No, you're not experienced, you've never driven an automobile before, you've not gone to a driving school, you've not taken any classes, you've not taken no lessons." So no matter how much she pleads or persuades you that, "Mom, I can do this," you won't give her the car because she has no experience. It's going to be dangerous for her. Now let's apply the same vehicle to you. You're an adult, you've been driving this car for several years, you go for grocery shopping with a car, you go to work with a car, and you call up your girlfriend, "Hey, let's go to New York, road trip." Are you going to say the same vehicle is going to be dangerous for you? No, you're not going to say that because you have the experience. You've been driving this for several years. It's not even an issue. You don't even consider it as an issue. The same thing applies to the stock market. The vehicle, the stock market, is not the culprit. No, it is the experience of the person behind the wheels that really determines the outcome, that really determines what you're going to get, that really determines the result you're going to get in the stock market. For you to really understand the mechanics of how the stock market works, it is very important to understand some terminologies and some buzzwords to really grasp the concept now. So right now, let's get right into it. So what is a stock? A stock is a tiny portion of a company. It's as simple as that. A stock is a piece of a company. It is a security that represents a part ownership, a fraction of a company. So when you own the stock of a company, that entitles you to a portion of the company's asset, growth, profit. So let's say, for example, a company represents this giant pizza, right? And usually a lot of companies, if not all companies, the outstanding shares, they are usually in millions and millions and millions. But for simplicity in this class, we're going to assume a company ABC has 1,000 outstanding shares. And you, an investor, you decide to buy 100 shares of this. That means that you own 10% of ABC company. That is 100 divided by 1,000, that gives you 10%. That means that in this particular example, you own 10% of the company ABC. And also in the investment community, you hear stocks, shares, equity. All of this mean the same thing. They are usually used interchangeably. You can say, I'm a shareholder, I'm an investor in equities. It literally means the same thing, right? So the next thing we want to talk about is assets. What is an asset? Asset is anything that creates economic value or is of economic value. Let's take, for example, cash or a piece of machinery, financial security, patents, property, land. An asset creates cash flow. It's as simple as that. Let's take, for example, you have a sewing machine and you design this beautiful sweater and you decide to sell that sweater on your website in exchange for cash. That sewing machine is considered an asset because it creates economic value. It creates money. Another example, you have a piece of land, you build a property there, you build a house there, and you in turn rent this house or this property to tenants who pay you every month or every year for the use of that property. That land and that building is considered an asset because it produces income for you every month or every quarter or every year. So again, that is considered an asset. Asset creates cash flow. Anything that creates money, that creates cash flow for you is considered an asset. In the same vein, stocks are considered asset because they create economic value over time through capital appreciation and dividends. These are two concepts I'm going to explain to you in subsequent videos, okay? But generally over time, investors, we buy stocks that we believe or we think is going to go up in value over time. And the importance of being a stockholder or being a shareholder is because it entitles you to a portion of the company's profit. So the more shares you own, the greater the portion of the profit that you have. So the next concept is, what does it mean when a company issues shares, or what does it even mean to issue shares? So companies usually issue or sells shares, okay, to fund the operations of the business. Issues just means to sell. Simple. When a company issues or sells stocks, they get that in return for money. So you think of the multi-billion-dollar companies like the Apple, the Amazons, the Tesla, the Facebooks. These are giant corporations that started as a small private company, but over time they became behemoths. They became giants in their industries, and because of their massive growth, they need access to capital. These companies, they are growing so much that they need capital from the external market, from the public market. So the next concept is initial public offering. What is initial public offering? So first, let's take a look at how a company goes public, because not all companies are publicly traded companies. So for example, your aunt, she owns this coffee and cake shop. That's a company, that's a private company because it's only owned by your aunts. And because it's solely owned, we public investors, we don't have access to it. We have no access to the books, to the revenue, to how the company operates, because all this information, they are kept confidential. And a lot of big companies like that, they are privately owned. For example, IKEA, the furniture company, it's a privately owned company. So let's say, for example, your aunt's coffee and cake shop starts doing really well. It starts growing. People love the product. They love the coffee and the cake, and business is blooming and people love it. And those shops start growing from 1 to 2 to 10 to 20. And now she starts deciding, okay, I want to franchise this, and this even gets better from 500 to 1,000. And now she's making the decision, I want to go public. I want investors like you and I to have access to buy the shares of my company. And remember what I said before, the reason why companies go public is because they want to raise capital, and because of that, that is going to help them to fund the operation of the business. So now that is called an initial public offering. Literally all the companies on the stock exchange, they've gone through an IPO. And the next concept that we want to talk about is, how are the prices of a stock determined? What really determines the price of a stock? Well, the price of a stock is determined by the forces of supply and demand. The stock market offers a very fascinating example of how the forces of supply and demand interact real time. And let me explain. For every stock transaction that happens, there is always a buyer and a seller. And because of the law of supply and demand, if there are more buyers for a particular stock, the price of that stock is going to go up. And if conversely there's not a lot of buyers for a particular stock, the price is going to go down. Or for example, a good news came out about a company, the price is going to go up because people go like, wow, good news, the company is expanding, wow, they have this great technology, oh, they are dominating their industry. That is going to push the price of that stock upward. But if, for example, the news came out that, oh, this company, they've been fraudulent, or the technology that they have is no longer relevant to the market, or there's another company doing something better, people will dump that stock, and because of that, the price of that stock is going to go down. But I want you to understand that the overall market is made up of millions and millions of traders, investors, buyers, and sellers with imperfect information about the value of a stock. And because of that, you see different prices for a particular stock. And depending on number of people that want or do not want the stock, it determines the direction of the stock. And that's what causes the minute by minute direction of a particular stock price. Okay? And again, so where does all this happen? This usually happens on the stock exchange. So what is a stock exchange? A stock exchange provides a platform that brings together buyers and sellers to trade. So you buying and selling a stock, this is all done on the stock exchange. So how do we even buy a stock? So when you want to buy a stock, when you want to invest in a stock, you have to choose a broker or a brokerage. Back in the days, you have to look for a physical stockbroker and go through all the paperwork, but with the advent of technology, you don't even need to do that. The way that I want you to see broker or an online discount brokerage, it's more like when you open a bank account. Okay, you open your bank account, you put money in it, you can have check-ins, savings, and because of that, you put money in it, and when you go shopping, you can just swipe your card because you've deposited money into it. The same thing applies to an online brokerage. You open your investment account in it. You can open your TFSA, RRSP, IRA, Roth IRA, any investment account that you want to open, you can open it within that brokerage. And then you can fund your account in it. You can transfer money into it. You can transfer money out. It's just picture it as your online bank, but this is not a bank. It's just an investment account. And once you make that deposit in your account, then you can go shopping. You can buy stocks. You can buy ETFs. You can buy bonds. You can buy whatever in your portfolio. But first of all, you have to transfer the money into your investment account, and once that is done, then you can go ahead and buy the stock on a stock exchange. And there are different types of stock exchanges. For example, the most popular one is the New York Stock Exchange. So this is where all the big American equity companies are usually traded. We have the NASDAQ. This is where the big technology companies are usually traded. We also have the Toronto Stock Exchange. This is where the Canadian equities are usually traded. So again, the next concept that we want to learn about is the bear and the bull market. Let's start with the bull market. A bull market is a market where the stocks or the value of the stock is on the rise or is rising. The economy is blooming. The economy is strong, it's solid, it's sound. Things are just moving. There's so many people with jobs. The economy is just good. It's just beautiful. It's just blooming. That's a bull market. But in a bear market, it's the opposite. things are declining, there is a recession, there are a lot of unemployment, there's declining value in the prices of a stock, that's when you see, when you look at the chart, is already things are going down. That is a bear market. But usually over time, the stock market tends to go upward, tends to go in the upward direction, tends to go bull. So that's where we're going to end today's class. And in the next class, we are going to talk about how do we make money in the stock market? How do we make money with stocks? So this is what we're going to discuss in the next class. But before then, if you have any questions whatsoever, leave me a comment down below. I read all your questions, I read all your comments, and if you have any feedback whatsoever, I'm looking forward to reading it. Thank you for joining today's class, and I will see you in the next one. Love you.